Hello and welcome to another episode of Kuvera Insights, where we talk to industry experts on how to best manage your wealth. Today we have a special guest from Aditya Birla Sun Life, Abhishek Singhal. Abhishek has been in the industry for 19 years. He has had rich experience in asset management, investment advisory, across business development, and new products. What's really interesting about his profile is that he heads passives and product initiatives. So a lot of the product innovation that you see that will come out or that is coming out in the AMC industry, he's playing his part in doing that within Aditya Birla Sun Life. Abhishek completed his bachelor's degree in commerce with honors and holds a master's in business administration. Welcome, Abhishek. How are you today?
I'm very well. Good morning, and thank you for calling me here, Gaurav.
So let's start with product innovation, right? So tell us a little bit more about what it means to head passives and product initiatives, and what kind of innovations are you seeing in the AMC industry right now?
Yeah, so products is essentially a very interesting space, and over the last 26 years, we've seen perhaps maybe three stages of innovation in this marketplace. Way back in late 90s or early 2000s, we used to see plain vanilla diversified products. These were largely access products. You were accessing all segments of the market through a diversified product, like an open-ended equity portfolio, an open-ended debt portfolio, and trying to access various parts or deeper parts of the market, which were more active, more vibrant, so to say. Creating alpha was not a problem, and it was sort of given at that point in time. Nobody used to think about benchmarks or index investing. And while index investing started in 1970s in the Western world, in 2010 and onwards, we saw the next wave of change, where you started seeing thematics come into play, various slicing and dicing of the market. You had growth fund, value fund, mid cap fund becoming large, small cap fund becoming more prominent. More thematics also coming into play. You had banking and financial, whole series of these funds coming in from across the industry. At the same time, you also saw participation coming through from foreign fund houses, some fund houses exiting, local fund houses becoming bigger, a lot of work happening on deepening of the marketplace, SIP as a vehicle becoming very big in India. Now in perhaps its third stretch, the industry is seeing alpha eroding across asset classes. The one big change, or two or three big changes that happened, one was recategorization way back in 2018, where all mutual funds became very templatized. So that the same 100 stocks are going to be bought in every large cap fund. The same 150 stocks are going to be bought in every mid cap fund. So what is the differentiation really? And that across categories, fund managers are finding it challenging to beat benchmarks. So a third wave which has started is towards passives, and this is perhaps the newest area of innovation which is happening. Today, there is hardly a differentiation between a large cap index and a large cap fund. Every portfolio that you see, including the index, you see the same 50 to 100 stocks. And the question is, at what cost am I able to access? So funds are becoming really big now. So a lot of innovation happening there. The difference that you're going to see in the coming days is that this innovation is not going to be limited to one asset class. So far we've talked about equities. You are going to see a much bigger innovation, much bigger disruption, so to say, happen even in fixed income space. In fixed income, no one had ever thought about index investing. It was easier to invest in index in equities because indexes were investable. In fixed income, the index is largely a theoretical index. All these bonds, because of their lot sizes, because of their impact cost, because of the way
let's take one step back, Abhishek. What are the debt indices that are available? Let's start from 101, because and I'm just saying this because I think a lot of people may not even know that there are debt indices that are available. What debt indices are currently available today? what kind of bonds and fixed income products do they track? And then let's get to how do we create an investable index out of them.
Fantastic. I think good observation. So, Gaurav, as per the mutual fund rules and regulations, every fund that we are investing in, whether it's a equity product or a fixed income product, it has to be compared with a benchmark. So we have to show our performances in relation to something called a benchmark. How is this benchmark created? A benchmark is nothing else but an index, and an index is essentially a portfolio of securities. If it's an equity fund, it's equity securities or equity shares and stocks. If it's a debt product, it's essentially bonds. Now, all these bonds coming from the same issuer or the same company. So, for instance, you have NABARD, you have REC, PFC, HDFC Limited, even Government of India, State Government of Maharashtra, State Government of Gujarat, and so forth. You can have variety of these bonds, all packaged into a portfolio. It becomes a benchmark. All benchmarks or all indices have one common factor. They could be maturing in a certain time period. They could come from the same line of issuers. For instance, all government issuers or all PSU issuers or all AAA rated issuers. So indices can be, sliced, diced, different recipes can be created. When you think of it as an investable index, you start to see, are these large enough? Are these deep enough? Are these liquid enough? And when I say liquid enough, can an investor actually go and invest in them? That's when they become basis for passive products on the fixed income side. So, for instance, this is a very new space in India. I think there are hardly 3 or 4 products available as of today.
Right.
In the coming periods, you are going to see more and more. And in fact, we are going to be launching one product very, very shortly in the next 2 weeks itself. What we are starting out with and what you are going to see more often going forward is custom indices or target maturity products. These are indices which are based on a common maturity date. So, for instance, what we are looking at launching is a September 2026 index for SDL and PSU. Now, what are SDLs? SDLs are state development loans, and PSUs are, public sector undertakings. So we are basically mixing the two very, very, very safe bonds, all of them up to 5 years of maturity, so that it creates
up to 5 years of maturity, not exactly 5 years. Not
exactly.
All of them are maturing. Understood. Okay.
For the simple reason that, all issuers come on different dates, they have different borrowing requirements.
Yep.
We are trying to screen out a list of these so-called safe issuers, which would be maturing at the same time or in the same period, and invest in them in a manner that, it delivers a certain amount of return to the investor.
Right.
The idea of this index is to sort of give a feeler that an investor is investing in an FD. Now, what is this target maturity product going to do? It's essentially going to give you a more tax advantaged sort of investment into a very, very predictable sort of portfolio. Assuming that you would have invested in 10 different FDs, HDFC Bank, ICICI Bank, SBI, Punjab National Bank, OBC. If you had invested in all these banks, all of them 5-year FDs, you would have had something called a portfolio of FDs. How each of them behaves or the return of each of them, a blended return would have given you one benchmark return.
Right.
Same approach applied to bonds.
So, quick question here: is there already a 2026 index available, and the bond fund or the passive debt fund will just track it? So, my question is: are there these indices already available in NSE and NBSE or the index providers, which can then be tracked, so that what I'm trying to kind of figure out what the parallel is with the equity space. In equity, what happens is you have the Nifty 50 index. It's been on for ages. You launch a Nifty 50 fund, and then you can see what the tracking error is because there is a fund that has been going on. Right? Is that something that we are going to see more and more on the passive debt side as well?
Yes. So as the industry is maturing, markets are getting finer and finer. The index providers are also working, day and night to have these newer indexes available. So far, we used to see, more innovation around thematic equity indexes. Of late, over the last maybe about year and a half, if you go on, let's say, the Nifty website or on the CRISIL website, you would see that there are a whole host of these indexes which are now available from both these providers. There are other guys also working on providing such indexes, and they're also looking at generating more and more of these indexes, which could potentially become more investable by nature. As
So, this leads to the follow-up question, right? Again, I'm drawing a parallel to equity because I think that's the easiest way to understand this, right? In equity, you have Nifty 50, which is for all practical purposes considered the market.
Yeah.
Either Sensex or Nifty 50, right? You pick the two, but that's what everyone reports on. That's what everyone mostly tracks. You might be investing in a small cap, but market is Nifty 50 or something. What is that equivalent on the debt side?
Sure. So let's pick up a liquid fund. We have something as basic as a liquid fund, which is sort of an overnight investment option. Almost every fund house will have a liquid fund available. You have 40 plus liquid funds available in the market today.
Right.
Almost half of them, almost all of them, would a Nifty liquid fund, a Nifty liquid index. That liquid index is an equivalent of a Nifty 50 on the equity side. Right? The difference between the two indexes is in a Nifty 50, all these securities are tradable. The index is tradable by even retail investors like me or maybe you. In a fixed income format, because every security has a minimum of 5 crore lot, these indexes may not be truly tradable. The market impact cost of trading is quite high. Typically a bond has, a short-term bond especially will be somewhere in the 4% to 5% yield scenario, maybe 6% if it's a long-term bond. In equity, the margin or the capacity to take that tolerance or that error or that impact cost is much higher. In fixed income, you can't afford a 15 basis point slippage or a 20 basis point slippage.
How do you structure it so that each security in the index has a 5 crore lot size? But as an investor, I want to invest 5,000 rupees, right? I mean, I'm not going to, and that 5,000 rupees has then to get split up amongst all the bonds because I want index-like returns. So, what are the challenges that are there that you're solving for?
Great question. And this is where the first basic rule for creating a fixed income index comes in: liquidity management. What we do while creating these new indexes or considering new indexes for passive investing is we consider the liquidity of the underlying bonds. Right. Can we go tomorrow to the market, buy and sell whenever we want to these particular bonds, or will they tend to be illiquid? Most long-term bonds tend to become illiquid 3 months to 6 months after they are launched, because the market is typically pretty liquid up to a 3-year or a 4-year segment.
Most investors also buy to hold, right? Most of the investors they buy the bonds to hold till maturity, right? It's a STM product. It's not like people don't buy bonds to trade them often.
After a 3-year segment, yes. Up to a 3-year segment, not necessarily. People do trade it almost on a regular basis, and which market liquidity plays a lot of role here. What we have observed over the last maybe about 6 to 9 months is that there are 2-3 different trends emerging. A, that market depth has started to increase. There is more liquidity available beyond the 3-year point. B, yields have sort of gone up pretty sharply, and more so on the 5-year end. On the 5-year end, the kind of yields being offered by SDLs, which are equivalent to government bonds or PSU bonds, is unnaturally high. In a AA or a AAA bond, you're getting a 5-year bond at roughly about 590 or 6%. But at the same time, a state development loan like a Maharashtra or a Gujarat, very, very highly rated, is also available at a 6% or maybe even slightly higher. So why do I need to take any sort of credit risk? I would rather create a portfolio of these particular, state government bonds. When we look at the liquidity, and we know that long-term investors like insurance companies or pensions, as you said, Gaurav, will buy them, keep them in their books as an HTM trade. When we create, and mutual funds are more active market players. So as more and more participants get into that space, market deepens further. You and me as 5,000 rupee, 10,000 rupee investors, what's in it for us? Mutual funds are helping bring together all these investors and create more liquidity in the marketplace. And hence the impact cost keeps on reducing over a period of time.